The crypto world is holding its breath as the U.S. Securities and Exchange Commission, SEC, continues to play hardball with major players like BlackRock and Franklin Templeton. But here's where it gets controversial. Despite the growing momentum in the digital asset space, the SEC has once again delayed decisions on several high-profile crypto exchange-traded funds, ETFs, leaving investors and industry leaders in limbo. This move raises questions about the regulator's stance on innovation versus investor protection. On Wednesday, the SEC pushed back deadlines for multiple crypto ETF proposals, including those from financial giants BlackRock and Franklin Templeton. According to official filings, Franklin Templeton's Ethereum staking ETF amendment now faces a November 13th deadline, while its Solana and XRP ETFs are slated for November 14th. Meanwhile, BlackRock's iShares Ethereum Trust staking proposal has been rescheduled for October 30th. These extensions come as the SEC exercises its maximum allowable time to evaluate these applications, leaving the industry guessing about its ultimate decisions. And this is the part most people miss. The SEC's delays aren't just bureaucratic red tape. They reflect a broader struggle to balance the explosive growth of crypto with the need for robust regulatory oversight. Under Section 19B of the Securities Exchange Act, the SEC has up to 45 days to act on proposed rule changes, extendable to 90, 180, or even 240 days in certain cases. This flexibility allows the agency to thoroughly assess the risks and benefits of these innovative financial products. The SEC's cautious approach comes amid a significant shift in its attitude toward digital assets. Since the launch of Project Crypto in July, led by SEC Chair Paul Atkins, the agency has vowed to modernize securities rules and create a unified framework for crypto trading, lending, and staking. At a recent OECD roundtable, Atkins boldly declared, "Crypto's time has come," signaling a pro-innovation stance. Yet the mounting pile of delayed ETF decisions, now numbering at least 92 according to an August report, suggests a lingering hesitation. Here's the kicker. While the SEC delays decisions, the crypto ETF backlog continues to grow. In August alone, the agency extended reviews for several proposals, including NYSE Arca's Truth Social Bitcoin and Ethereum ETFs, 21 Shares Solana and XRP ETFs, and SIBO BZX's WisdomTree XRP fund. Earlier this week, the Bitwise Dogecoin ETF and Grayscale Hedera ETF were also pushed back to November 12th. This pattern raises a critical question. Is the SEC dragging its feet, or is it simply being thorough in an uncharted territory? For beginners, ETFs are investment funds that trade on stock exchanges, allowing investors to gain exposure to a basket of assets, in this case cryptocurrencies, without owning them directly. The approval of crypto ETFs could open the floodgates for mainstream adoption, but regulatory concerns about market manipulation, volatility, and investor protection remain front and center. As the SEC navigates this complex landscape, the industry is left to speculate. Will these delays stifle innovation, or are they a necessary step toward creating a safer, more regulated crypto market? What do you think? Is the SEC's cautious approach justified, or is it holding back the future of finance? Let us know in the comments below.